who joins us right now, right? I mean, you see big things happening in the second half of the year.
Yeah, we do, Scott. And, we've been bullish, right, all year long. We came into this year overweight, seeing potential for new high this year. People thought we were crazy when we said it. But let's just look real short term here, right? July, the S&P 500 has been higher 9 of the last 10 Julys. The QQQ, the NASDAQ 100, has been higher every July since 2008. Now, believe me, there's lots of things to look at here. But you think about some of the things that Mike just talked about, some of the other guests, right? The broadening out we've been seeing, right? You've got, consumer names breaking out relative to staples. You got all-time highs in various advanced decline lines. There's a lot more participation than we've seen in a long time. Now, I know I sent you guys a chart. Hopefully you can put it up. What happens when you're up at least 10% for the year? The rest of the year on a median returns up about 10%, double the average. But here's what's really interesting. I call this a sweet spot, Scott. When the S&P is up between 12 and 17%, so not way up, not way low, right in the sweet spot, the rest of the year has been higher 10 out of 10 times, almost 11% on median return. So there's lots of factors, yes, but we've been bullish. We still think there's a rally. Now, one more point here, like Mike said, maybe we're due for a pullback sometime August, September, October. Perfectly normal, but we'd be a buyer of any weakness.
I mean, I don't know. You mentioned Mike. He's our resident stock trader's almanac. And history doesn't always hold true to how it may seem. And this time is a little bit different on a number of accounts.
Without a doubt. And by the way, Ryan has his own scroll there that he shares with everybody. And, he's got a real good handle on the tendencies of things. I think what's interesting now is some of these very reliable patterns, one or more have to probably be wrong in some respect. When you're talking about whether it's when the yield curve inverts and what does it mean for markets,
right.
What does the Fed do and how do markets react to it? We've kind of gotten through a lot of that, and I'm willing to allow for some play in those relationships here, in part because I think the yield curve got inverted in a hurry because you had the most transparent and aggressive Fed at the same time, and we got there early, and it's really telling you that inflation is going to be moderating more than anything else. So I'm with you. I think that, the election year pattern has worked to an absolute T. Midterm election, you bought it on that moment, you're up huge. That sort of takes you into around now, right through July is when that pattern tends to work out. In terms of how it's the interplay with the business cycle, I think it's still a big question because profits have been more resilient than you might have expected. The economy has not shown much give. The nominal growth still is sustaining equity prices at these levels, but valuations don't look great, but that's never a timing mechanism.
Anything, Ryan, concern you? You can't just be, overwhelmingly bullish. There's got to be something on your mind that says, well, maybe this could upset my view.
Sure. I mean, the Fed, we don't think they don't need to hike anymore. The Fed, well, it seems like they want to keep hiking. Valuations, like Mike said, are a little bit stretched. But one thing I want to point out here, the hard versus soft data argument, just today, right? The manufacturing data wasn't very good. Look at last week, though. That's the soft data. The hard data last week, we've seen CapEx starting to bottom and go higher. So we've never seen a period like this before. We're going to continue to follow the hard data, not so much those surveys, which, again, people are bearish for whatever reason. But the hard data says don't be so bearish and look for higher prices.
I wish you the best. Have a good holiday, Ryan Detrick.